Why NYC apartments could become a big problem for NYCB. Investors have punished the stock of commercial real estate lender New York Community Bancorp, NYCB, so far this month. To know why, it helps to understand the changing economics of a New York City staple, the rent-stabilized apartment building. The regional bank's biggest loan exposure is to apartments. Roughly half of that portfolio is tied to scores of multifamily complexes in the Big Apple where annual rent increases are regulated by the government. And this is what has investors worried. These properties could end up being worth a lot less than they used to be because of high interest rates and new limits on rent increases, leading Wall Street to question whether this $116 billion lender will be able to withstand the losses that are expected over time. The Hicksville, NY-based bank is trying to convince investors that it has the situation under control. NYCB's new executive chairman Alessandro Danello told analysts Wednesday that the company would work to reduce its commercial real estate exposure. The bank also has $3 billion of loans tied to office properties, another potential area of future weakness as work patterns shift in big cities. On Friday, Danello and other board members purchased roughly $873,000 of NYCB shares, and that vote of confidence helped push the stock up 17%. It is still down by 53% since January 31st, when it surprised analysts by slashing its dividend and reporting a net quarterly loss of $252 million. The bank announced that day it had set aside $552 million for future loan losses, well above estimates, to account for weaknesses tied to office properties and multifamily apartments. NYCB has its roots in New York City. It was founded in 1859 as the Queens County Savings Bank, the first savings bank chartered by the state of New York and Queens. The company went public in 1993 and in the subsequent decades became one of the city's biggest lenders to the owners of rent-stabilized buildings.